Hey everyone, welcome back to Chat ETF. Today we're diving deep into a relatively new player on the scene, Simplify Aggregate Bond ETF, also known as AGGH. AGGH promises active management for bond investors, but is it all it's cracked up to be? Can it really outperform the market? We'll be breaking down AGGH's strategy, its risks, and how it compares to the classic, passively managed bond ETFs. But before we jump in, let's hit the pause button for a quick question. Are you looking for potentially higher returns from your bond holdings, even if it means a bit more risk? Or are you prioritizing stability and predictability? Let us know in the comments below. Question 1. What is Simplify Aggregate Bond ETF, AGGH? The Simplify Aggregate Bond ETF, AGGH, is an actively managed exchange-traded fund, ETF, designed to provide core investment-grade bond exposure with the potential for enhanced returns. Here's a breakdown of its key features. Investment objective. Maximizing total return. Unlike some bond ETFs that prioritize income generation or capital preservation, AGGH aims to deliver a combination of both through capital appreciation and interest payments. Strategy. Core bond exposure. The foundation of AGGH lies in investment-grade (IG) bonds. These are generally considered safer as they are issued by corporations and governments with a high creditworthiness. Credit hedge strategies. AGGH goes beyond simply holding bonds. The fund employs various strategies to potentially boost returns or mitigate credit risk. These strategies can involve efficient curve positioning. This involves strategically buying bonds with maturities that the manager believes offer the best potential return for the level of interest rate risk. Defined risk option writing. The fund might sell, write, call options on certain indices or individual bonds. This generates income upfront, but limits potential upside if those underlying assets significantly appreciate. Quality junk factor-based hedges. The fund might utilize derivatives to hedge against potential downgrades of IG bonds to lower credit quality, junk. Benefits. Potentially higher returns. Compared to a traditional passively managed aggregate bond ETF, AGGH's active management and credit hedge strategies aim to generate a higher total return. Diversification. By holding a variety of investment-grade bonds and potentially using options, AGGH seeks to diversify its holdings and potentially reduce overall portfolio risk. Convenience. As an ETF, AGGH offers investors a transparent and easily tradable way to gain exposure to a diversified pool of bonds. Question 2. What is Simplify Aggregate Bond ETF AGGH's primary objective? Is it total return, income generation, or capital preservation? Simplify Aggregate Bond ETF AGGH prioritizes total return as its primary objective. This means it strives to deliver a combination of capital appreciation, increase in the price of the ETF shares, and income generation, interest payments from the underlying bonds, over time. Here's a deeper explanation compared to income-focused or capital preservation bond ETFs. Income-focused bond ETFs. These ETFs typically invest in high-yielding bonds, prioritizing generating regular income payments for investors. They might hold a larger allocation to corporate bonds and emerging market bonds, which generally offer higher yields, but also carry greater credit risk. Capital preservation bond ETFs. These ETFs aim to minimize share price volatility and return the principal investment amount at maturity. They often invest in short-term government bonds with low credit risk but also lower potential returns. AGGH takes a middle ground between these two approaches. Core investment-grade exposure. The foundation of AGGH lies in investment-grade bonds. These are generally considered safer and offer some level of regular income. Active management and credit hedge strategies. On top of the core bond holding, AGGH actively manages the portfolio to potentially enhance returns. This might involve selecting bonds with better potential for price appreciation. Using derivatives, like call options, to generate additional income. Employing strategies to hedge against interest rate fluctuations or credit downgrades. By combining these elements, AGGH seeks to achieve a balance between income generation and capital appreciation for overall total return. Question 3. How does Simplify Aggregate Bond ETF, AGGH, achieve its objective? Explain the core bond exposure and the credit hedge strategies employed. Simplify Aggregate Bond ETF, AGGH, achieves its objective of maximizing total return through a two-pronged approach. 1. Core bond exposure. Investment-grade bonds. The foundation of AGGH lies in holding a diversified portfolio of investment-grade IG bonds. These bonds are issued by governments and corporations with a high creditworthiness, meaning there's a lower risk of default. Income stream. These bonds generate regular interest payments, providing a steady stream of income for AGGH investors. Potential for price appreciation. While considered safer, IG bonds can still experience price fluctuations based on market conditions. AGGH seeks to benefit from this by maturity selection. The fund might strategically choose bonds with maturities that offer the best potential for price appreciation based on the manager's outlook on interest rates. For example, if interest rates are expected to decline, longer-term bonds could see their prices rise more significantly. Credit quality selection. Within the IG spectrum, the fund might choose bonds closer to the higher-yielding end, but still IG, that could offer more potential for price appreciation compared to very high-rated bonds. 2. Credit hedge strategies. On top of the core bond exposure, AGGH utilizes various strategies to potentially enhance returns or mitigate credit risk. These strategies add a layer of complexity, but can be beneficial if managed effectively. Here are some common techniques. Efficient curve positioning. This involves strategically buying bonds across different maturities. The goal is to maximize the potential return for the level of interest rate risk taken. For example, the fund might buy a combination of short-term and long-term bonds based on their current yields and the manager's view of future interest rate movements. Defined risk option writing. AGGH might sell, write, call options on certain indices or individual bonds. Benefits. Income generation. Selling, writing, call options generates upfront income, premium, for the fund. This can boost overall returns. Downside protection. The options sold typically have a strike price, exercise price, above the current market price of the underlying bond. If the bond price doesn't rise above the strike price by the option expiry date, the option contract expires worthless, and AGGH keeps the premium income. This can provide some downside protection for the bond holdings. Drawbacks. Limited upside. If the bond price significantly appreciates above the strike price, the option buyer will exercise their right to purchase the bond from AGGH at the lower strike price. This limits AGGH's potential gain from the bond's price increase. Quality junk factor-based hedges. The fund might utilize derivatives to hedge against potential downgrades of IG bonds to lower credit quality, junk. These derivatives could be credit default swaps, CDS. These are essentially insurance contracts where AGGH pays a premium in exchange for a payout if a bond issuer defaults. This can help mitigate losses if any of the underlying bonds in the portfolio experience a downgrade. Inverse high-yield bond ETFs. These ETFs aim to deliver the opposite return of the high-yield, junk, bond market. By holding a small inverse position, AGGH can potentially offset some losses if the junk bond market experiences a downturn, potentially impacting the credit quality of some IG bonds. Question 4. How does Simplify Aggregate Bond ETF (AGGH)'s expense ratio, 0.33%, compare to similar bond ETFs? Here's a breakdown of how Simplify Aggregate Bond ETF (AGGH)'s expense ratio, 0.33%, compares to similar bond ETFs. Expense ratio comparison. AGGH, 0.33%, falls within the mid-range for actively managed bond ETFs. Passively managed bond ETFs generally have lower expense ratios, often ranging from 0.05% to 0.20%. These ETFs simply track a specific bond index, requiring minimal ongoing management fees. Other actively managed bond ETFs can have expense ratios anywhere from 0.20% to 1% or even higher. The specific cost depends on the complexity of the strategy and the experience of the fund manager. Understanding the trade-off. Lower expense ratio. Passively managed, lower fees translate to a higher portion of your returns being retained. However, passively managed bond ETFs simply replicate an index, offering limited potential for outperformance. Higher expense ratio. Actively managed, higher fees eat into your returns, but the active management aims to generate a higher total return compared to the benchmark index through strategic bond selection and potentially using options and other derivatives. For AGGH, 0.33% specifically. It sits at a point where the expense ratio is not the lowest, but it's not excessively high either compared to other actively managed bond ETFs. The key question is whether the potential for higher returns through active management justifies the 0.33% expense ratio. Question 5. How does Simplify Aggregate Bond ETF (AGGH)'s investment strategy differ from a traditional passively managed aggregate bond ETF? The investment strategies of Simplify Aggregate Bond ETF (AGGH) and a traditional passively managed aggregate bond ETF differ significantly in their approach to achieving returns. Here's a breakdown of the key differences. Traditional passively managed aggregate bond ETF. Objective: tracks a specific bond index, such as the Bloomberg US Aggregate Bond Index. Strategy: the fund simply buys the same proportion of each bond in the index it tracks. This ensures the ETF's performance closely mirrors the index, offering broad market exposure to the aggregate bond market. Management: the fund requires minimal ongoing management, leading to lower expense ratios, typically 0.05% to 0.20%. Returns: aims to deliver returns that match the underlying index, minus fees. Risk: generally considered lower risk, as the fund's performance is tied to the broader market. However, it also limits the potential for outperformance if the index experiences a downturn. Simplify Aggregate Bond ETF (AGGH). Objective: aims to maximize total return by combining core bond exposure with active management strategies. Strategy: core bond exposure holds a diversified portfolio of investment-grade bonds, similar to a traditional aggregate bond ETF. Active management: the fund employs various strategies to potentially enhance returns or mitigate risks, beyond simply mirroring an index. This might involve selecting bonds with better potential for price appreciation, using derivatives like call options to generate additional income, employing strategies to hedge against interest rate fluctuations or credit downgrades. Management requires active management by a team of portfolio managers, leading to a higher expense ratio, 0.33% for AGGH. Returns: seeks to achieve a higher total return than a traditional passively managed bond ETF through a combination of income generation and potential capital appreciation. However, there's no guarantee about performance, and the fund's performance relies on the skill of the managers. Risk: potentially higher risk than a traditional passively managed bond ETF due to active management and the use of options and other derivatives. These strategies can add complexity and introduce additional risks if not managed effectively. Here's an analogy. Think of a traditional, passively managed bond ETF as a pre-built basket of groceries that reflects the average shopping list. You know exactly what you're getting, and it fulfills basic needs. AGGH, on the other hand, is like having a personal shopper who selects groceries based on current market conditions and potential deals. You might get higher quality items or better overall value, but there's also a chance of ending up with something unexpected or outside your budget. Choosing between the two depends on your investment goals and risk tolerance. Passively managed, suitable for those seeking a low-maintenance, lower-risk option with predictable returns that track the broader bond market. AGGH, more suitable for investors comfortable with some additional risk and complexity in exchange for the potential for a higher total return through active management. Question 6. How does Simplify Aggregate Bond ETF (AGGH) plan to adapt its strategy in different market environments? Simplify Aggregate Bond ETF (AGGH) seeks to adapt its strategy across different market environments to potentially maximize total return while managing risk. Here's a breakdown of how AGGH might adjust its approach. Poor bond exposure. Interest rates. The fund might adjust the maturity range of its core bond holdings. Rising interest rates. AGGH might shorten the duration of its holdings to minimize potential price declines caused by rising interest rates. Conversely, longer-dated bonds are typically more sensitive to interest rate fluctuations. Falling interest rates. The fund might extend the duration by investing in longer-term bonds that could benefit more significantly from falling interest rates. Credit quality. The allocation within investment-grade bonds might shift based on the economic outlook. Strong economy. The fund might hold a higher allocation towards bonds closer to the lower end of investment grade, higher credit quality, that typically offer lower yields, but potentially lower default risk. Weak economy. The fund might tilt its allocation towards higher-yielding bonds within the investment-grade spectrum, aiming to balance the potential for higher returns with maintaining an overall investment-grade profile. Active management strategies. Option strategies. The use of options like call writing could be adjusted based on the market environment. Volatile markets. AGGH might reduce its use of call writing strategies to avoid potentially limiting upside potential if bond prices rally unexpectedly. Stable markets. The fund might write more calls to generate additional income if interest rates and credit spreads are expected to remain stable. Hedging strategies. The types of hedges employed could change, depending on the perceived risks. Interest rate hedges. During periods of high interest rate volatility, AGGH might utilize interest rate derivatives to hedge against potential losses if interest rates rise more than anticipated. Credit downgrade hedges. The fund might increase its use of credit default swaps or inverse high-yield bond ETFs if there's a heightened concern about potential downgrades of IG bonds to junk status. Overall, AGGH's strategy is not static. The fund manager actively monitors market conditions and adjusts the portfolio allocation and credit hedge strategies to try to capture opportunities and mitigate risks in different environments. Question 7. What are the potential benefits and drawbacks of using options and other derivatives in Simplify Aggregate Bond ETF (AGGH) strategy? Simplify Aggregate Bond ETF (AGGH) utilizes options and other derivatives in its strategy to potentially enhance returns or mitigate risks. However, these instruments come with both benefits and drawbacks to consider. Benefits. Enhanced income generation. AGGH can use strategies like writing call options to generate additional income upfront, premium. This can boost the overall return of the ETF. Downside protection. Certain option strategies can offer some downside protection for the underlying bond holdings. For example, writing covered calls can limit potential losses if bond prices decline. Hedging against specific risks. Derivatives like interest rate swaps or credit default swaps can be used to hedge against specific risks, such as rising interest rates or potential downgrades of bond issuers. This can help AGGH maintain a more stable overall portfolio performance. Greater flexibility. Options allow the fund manager to make more targeted bets on specific market movements, potentially leading to higher returns than a purely passive approach. Drawbacks. Complexity. Options and other derivatives can be complex instruments. Understanding their mechanics and the associated risks is crucial before investing in a fund that utilizes them. Limited upside potential. Strategies like writing call options can limit the potential upside if the underlying bond prices significantly appreciate. The option buyer gets to purchase the bond at a predetermined price, capping AGGH's gains. Increased costs. Trading options and other derivatives can incur additional transaction fees that eat into the overall returns of the ETF. Counterparty risk. Derivatives involve contracts with another party, counterparty. If the counterparty defaults on its obligations, AGGH could suffer losses. Mispricing risk. The value of derivatives is derived from complex calculations and can be susceptible to mispricing. This can lead to unexpected losses for the ETF. Question 8. How does Simplify Aggregate Bond ETF, AGGH, define and measure its risk profile? Simplify Aggregate Bond ETF, AGGH, likely utilizes a combination of quantitative and qualitative measures to define and measure its risk profile. Here's a breakdown of potential approaches. Quantitative measures. Duration. This metric measures the average weighted maturity of the bonds held by AGGH. A higher duration indicates greater sensitivity to interest rate changes. AGGH might disclose its average portfolio duration and how it compares to a traditional aggregate bond ETF. Yield to maturity, YTM. This represents the expected return on an investment if held until maturity. By analyzing the YTM of the underlying bonds, AGGH can estimate the fund's overall income potential and potential sensitivity to interest rate fluctuations. Effective duration. This measure considers not only the maturity of the bonds, but also the embedded call options, if any, used in the strategy. This provides a more comprehensive picture of the fund's interest rate sensitivity. Credit quality metrics. AGGH might disclose the average credit rating of the bonds it holds and the distribution across different credit rating categories within investment grade. This helps assess the overall credit risk of the portfolio. Volatility measures. AGGH might report historical standard deviation or other volatility measures to show how the fund's price has fluctuated over time. This can be compared to passively managed bond ETFs to understand the potential for higher or lower volatility associated with AGGH's active management strategies. Qualitative measures. Investment strategy analysis. The fund prospectus or fact sheet should outline AGGH's overall investment strategy and how it aims to manage risks. This includes details on the types of options and derivatives used and their intended purpose, e.g., income generation, hedging. Stress testing. AGGH might conduct stress tests to simulate how the portfolio would perform under various economic scenarios, such as rising interest rates, recessions, or credit downgrades. While not publicly disclosed, these tests can inform the fund manager's risk management approach. Historical performance analysis. Analyzing AGGH's historical performance during different market environments can provide some insight into its risk profile. However, past performance is not necessarily indicative of future results. It's important to remember. AGGH doesn't provide a single, definitive risk score. Understanding the various metrics and qualitative factors mentioned above paints a more complete picture of the fund's risk profile. The risk profile of AGGH can change over time as the fund manager adjusts its strategies and the underlying holdings. Question 9. How does Simplify Aggregate Bond ETF (AGGH's) portfolio turnover rate compare to similar bond ETFs? Simplify Aggregate Bond ETF (AGGH) likely has a significantly higher portfolio turnover rate compared to similar bond ETFs, particularly passively managed ones. Here's a breakdown of the reasons. Portfolio turnover rate. This metric measures how frequently a fund buys and sells its holdings within a year. It's expressed as a percentage and reflects the overall trading activity within the portfolio. A high turnover rate indicates frequent buying and selling, potentially leading to higher transaction costs for the fund. A low turnover rate suggests the fund holds its investments for longer periods, potentially reducing transaction costs. AGGH versus similar bond ETFs. AGGH, due to its active management strategy, AGGH is likely to have a high portfolio turnover rate. This is because the fund manager actively selects and trades bonds to potentially enhance returns or implement credit hedge strategies that might involve options and derivatives. The AGGH prospectus mentions a 400% portfolio turnover rate for the most recent fiscal year, which is significantly higher than the average. Passively managed bond ETFs. These ETFs typically track a specific bond index. They buy and hold the same proportions of the bonds in the index, resulting in a low portfolio turnover rate. Transaction costs are generally minimal in passively managed bond ETFs due to their buy and hold approach.